Housing. We've got a disaster reported on Twitter, and while we cannot yet independently verify this, it is a red flag that has a logical basis, and it's very fascinating. So here's an individual called Jacob at Raleigh Fam. Jacob says the following: I'm a new home sales rep. Okay, let me just explain that really quick because a lot of people might not understand what that means. It means you're a real estate agent who stands at the open house for a home builder and you try to sell new homes. Okay, so he's a real estate agent who's trying to sell new homes. Okay, all right. For a top 5 American builder. New home sale reps are a small community. In other words, they all talk to each other. Oh, he literally says that. We all talk to each other. Builders are inflating the numbers. Wait a minute. Builder stocks and builder earnings calls have actually been very good. They've been bragging about how things are getting better in December and January and things are looking up and up. But wait a minute. Builders are inflating the numbers, keeping bad contracts and bad loans on the books to prevent showing cancellations. So what do we have over here? He gives us a chart that shows how cancellations for companies are up substantially, over double. For Meritage Homes, you've got Pulte Home Group over here, double. D.R. Horton, you've got double. You've got cancellation rates basically skyrocketing. And you also have a substantial decline in net new orders. This we've actually seen in publicly available statistics as well. We know that cancellation rates have skyrocketed, and we know that net new orders have fallen. We already know that, so that's actually not a secret. So statistically, we already know that some of that data is happening. But what's really alarming is this idea that builders are potentially inflating the numbers. So what rationale does he give for inflating the numbers, and how could we potentially deduce truth from that? Well, first of all, what else does he say? He says here, unfortunately, it's going to get bad. Okay, well, that's anecdotal. Let's get to where some more of the insight is. For example, in the past, we would immediately cancel or not even write a contract / build if we found you weren't qualified. Over the last 3 months, 90% of what we are forced to write are unqualified contracts because the qualified buyers are gone. These unqualified buyers won't be able to close. So what we're seeing is all the new home sales are worthless, but we have a gun to our head that if we don't hit our quota of 3 to 6 homes sold a month, we will be laid off or terminated. So we have to write the contracts, but they won't close. The base prices are too high, but we can't drop the base price because the backlog under contract won't appraise. So instead, we're doing incentives. But incentives stopped working months ago. So builders are stuck. If we drop prices, the already bad contracts will be even more bad. Okay, so let me explain this, because this is very tricky if you're not from the real estate world. And I'll try to explain the potential impact of this because it is concerning. Especially since when you look at companies like Lennar, the darn stocks have actually recovered substantially from their loans or from their lows last year. In fact, here, just go to Google really quick, type in Lennar stock, and look at this sucker over the last year. It's up 11% from a year ago. You look at the last 5-year chart, the sucker had a dip and a low in June, but it's recovered 57% from June. How does that potentially make sense when housing prices haven't even really shown their year-over-year fall yet? Maybe it's the perfect short opportunity. We'll be talking about that a lot more, by the way, in our trading challenge that we've got coming up. We're officially launching the team trading challenge for course members in the Stocks and Psychology Money Group. Remember, of course, which you can get lifetime access to by the link down below. But here is how housing works when it comes to new construction builds. So let's say you have a buyer who comes in on today, okay? So today is February 11th, and they're like, hey, I want to buy lot number 152. So you're going to buy lot 152, and you're going to go under contract for, let's say, $500,000. But in order to be convinced to go under contract for $500,000, you're like, well, I want $20,000 of incentives. Now, that'll buy you maybe new flooring, and it'll cost the builder $7,000 to do the flooring, so the builder actually props up their margins by giving you this $20,000 incentive, because they're giving you $20,000 of apparent value, which is what you think you're getting, but you're really only getting $7,000 of value. But that's how builders make money. They want you to buy upgrades through the builder. That's where they make a lot of money. But builders are also making a lot of money because guess what? The lot they built this property on, they built number 152. Guess when that lot was probably purchased? Okay, and this gets really scary. Are you ready for this? Guess when the lot was probably purchased for the house number 152 that's selling today? 2019 or 2020? Guess what real estate prices were in 2019 and 2020? Much lower than they are today. Why is that really interesting? Well, it means that the builder margins are still today being propped up by low lot sales from 2019 and 2020. Well, lot sales in 2021 and 23 and 22 are much more expensive. Specifically 2021, which is what we're going to see next. Like the 2021 lot sales, we'll actually start seeing those come up in 23 and 24 here, right? The 2021 lot sales are going to be extremely expensive relative to what home prices are likely to be when they actually start falling more in 23 and 24 and through the rest of really this year, because we're in 2023. So the lot prices are way higher now for the homes that are coming up. But the homes that are selling today are still selling with low lot prices. So it artificially makes the home builder profits look high right now. So the home builder profits look high right now because of a low base cost from low lot values. But when those higher lot values come in, you're going to have a big oopsie doopsies. And those higher lot values will probably start coming in later in 2023. So dangers for housing? Well, for builders, it's going to be higher lot values as an input cost for builders at the end of 2023 plus, right? Getting rid of that cheaper previous lot inventory. That is going to be a drag on the home builders towards the end of 2023. So keep that in mind, okay? Now, while you keep that in mind, let's go back to what this guy on the Twitter thing said, basically about, we'll use our example here, lot 152. What is a builder backlog? Well, when somebody says we have a builder backlog that we want to make sure can appraise, what they're actually talking about is under contract deals. So the loser who bought property, let's say 150, let's say 149, okay? So the loser who bought property 149 for $500,000 as well, January, let's say 28th, their appraisal is in part going to rely on the appraisal of the new sales. But it's also going to rely on the losers who bought property, like 130 in December. Say December 30th. There we go, December 30th. All right? So if the person who bought a home in December for $500,000 got, $10,000 in flooring incentives, and the guy who bought the home in January got $15,000 in flooring incentives, and the guy who's buying the home now is getting $20,000 in incentives, what you're basically doing is you're technically reducing the value of the homes without actually reducing the value of the homes. So you're basically giving people money to artificially keep home values up in the new home builder areas, because you're giving people incentives to reduce the actual price of the property without reducing the appraised value of the property. See, when the appraiser goes in to appraise lot 142 in this example that was sold in January, the appraiser is going to go, hey, well, what did things sell for in December? $500K, sir. Well, what are things selling for now? $500K, sir. And the appraiser's like, sounds good to me. I guess your appraisal is $500,000. This is no skin off appraisals. It's just the way the system works. That's what the banks want. The banks want the appraisals. Now, might there be some notes about incentives? Sure. Do the banks really care? No. So lending could potentially be propped up by artificially high appraisals because of incentives. and they don't have to be monetary incentives. The builder could have already gone in and upgraded the homes. So in theory, they don't have to give you the 20 grand. They could just go, hey, have this home with fancier flooring. And the appraiser can't really adjust for that very well because they're already new homes. You're already on a condition level. I think the new construction C1, it's hard to go C1 is even better than like, I think new construction might be C2. I'm not an appraiser. But basically there are these classifications. And it's hard to say just because one house has slightly better flooring that all of a sudden the entire condition value of that house is so much more and you have to make an adjustment for it. I'm really going to skim past this really quick, but I'm basically telling you a home builder can throw an extra 50 grand into a house and it's not going to make it so much substantially different that the appraiser is actually going to be able to make any kind of difference on the valuation for that. Generally, when you have valuations that are different because of the condition, it's because somebody went through and spent, $500,000 on a remodel for a $5 million home versus somebody else who spent $50,000 on a remodel on a $5 million home, right? Then you could get more condition adjustments for stuff that's new. Like, in other words, what I'm saying is for like the 99-cent new flooring to actually make a difference compared to the $7 new flooring, everything in the home needs to be built to a substantially better degree for it to actually make a difference in the appraisals. And so the point of saying that is that home builders can artificially keep home values high by just putting in slightly better flooring, and the appraiser's not actually making a negative adjustment for that. In other words, in 2 months from now, you could still sell a home for $500K, and you could potentially put $40,000 worth of upgrades into it, and the appraiser's not making an adjustment for it. The appraiser's like, well, it looks like we're still at $500K. That's called dealing with your backlog. That's making sure your next homes that are being sold aren't ruining your prior appraisals. That's what this individual on Twitter is saying. And the individual here is making this argument that people might not be able to qualify for these homes, but we're writing the contracts anyway because we basically want to inflate the numbers because we don't want to lose our jobs. So the builders are like, you guys need to sell these homes. Do whatever you got to do to sell the homes or else you're fired. And the sales reps are like, dude, nobody's coming in to buy these homes even because we're giving them incentives. And this is where it becomes concerning. And the sales reps are like, whatever, we'll just write the contract anyway and send it to the builder. The builder just cares about getting contracts. So the sales rep writes the contract, sends it to the builder. The builder's like, okay, got a contract. All right, somebody's willing to pay $500K. Great, sounds great. Hey, appraiser, by the way, we got another contract for $500K. We're doing good. When the reality is, if that person doesn't close, eventually the cards fall. Eventually, those deals fall through and cancel. And when those deals fall through and cancel, what happens? Inventory goes up. And that's the biggest concern that you have for real estate is an increase in inventory. So increasing inventory probably doesn't come from resale homes because people have locked in low interest rates, right? It probably actually comes from new construction home builders who are resistant to large-scale price reductions in the face of higher rates. And what have rates been doing recently? Rates have jumped. They came down a little bit in December and January, but they've jumped right back to nearly, we're on the path back to nearly the highs that we had in October and November. We're not quite there yet. We are there on the 2-year, but mortgage rates generally follow the 10-year Treasury yield. And the 10-year Treasury is sitting at 3.7. We went down to like 3.3 just a little bit ago, and we were trending down, but now we're trending up. So with rates jumping and this potential inventory surge coming from new construction, at the same time as you get year-over-year pain in real estate, you've got the potential, and you have REIT liquidations because people want their money out of REITs. You've got some potential issues. Now, the year-over-year numbers are important to look at. We can actually look at some of the year-over-year numbers by looking at the Redfin data center. And it's really simple that we're going to end up crossing these year-over-year numbers, which actually finally start creating fear in the real estate market that, oh my Lord, home prices are actually coming down. Because right now, if you look at year-over-year prices a year ago, we're actually still higher than where we were last year, nominally. See, take a look at this. Home prices right now, national average, sitting at $347. Well, that's about 1% higher than where we were last year in January. And what happens if we stay at $347 and all of a sudden we get to, say, March and we compare to $374? Well, 374 year over year, now became 347, you're down 7.3%. Now all of a sudden people start getting nervous. And then what happens when we get to May or June or July where we're actually comparing 347, assuming housing prices don't fall anymore, compared to 388 on a national average? Home prices are now down over 10%. And that's not even going into some markets where things are getting ugly, like, Boise's a good one. You go to, like, for example, Boise, Idaho. What do you have over here? Look at that. Housing prices are falling even more every single week. So you're looking at 444 divided by 547. When you get to that comparison, you're down almost 19%. So you do have some serious issues coming for real estate. So the dangers for housing are these higher lot values, which are going to kill margins for builders, in addition to cancellations at builders. I think that potentially, combined with high values for builder stocks, actually creates a really good short opportunity for builders. Potentially. You know, I'm not telling you it's a guarantee. It's certainly not personalized financial advice for your portfolio. But anyway, there's a huge danger for builders and builder stocks. There's a very big risk of increasing inventory, lowering prices, not because homeowners are selling, but because of REIT liquidations and builders. But then when you get the year-over-year fear combined with rates jumping, you have even more of a problem. In my opinion, in order to actually prevent a more substantial housing burden or crash, you need to see the 10-year Treasury yield get below 2.75. I've been pounding my fist on the table for over a year now saying the more the 10-year Treasury yield is over 2.75, the more pain you're going to get for longer. And it's been pretty volatile over here. You can see on this chart, the chart is unfortunately trending up again. Now, hopefully that stops. Maybe this CPI report comes in low and the high jobs report everything leads to disinflation. Great. Then you put a floor under the housing market. You get your 15 to 25% correction, as I've been talking about for a year on this channel. I've been talking about this since January of 2022. This 15 to 25% correction coming. People called me, crazy. Now we've already seen 15 to 20% declines, and there's the potential of even more declines. But I hate to say it. This guy's tweet, Jacob, this is bad, because really what you're suggesting is that home builder stocks are rallying under false pretenses, that really home builders unintentionally, just because home sales reps don't want to lose their jobs, you're basically having inadvertent fraud happening to prop up sales for people who are buying homes with appraisals that are based on houses actually selling for what somebody is in escrow for, next down the line, lets the backlog appraise under false pretenses that somebody's actually, buying a home after someone else at the similar valuation. That's scary. So you get some real issues happening in the new construction space, and I would be very cautious, and I'm potentially considering opening up shorts on some of the home builders that I choose. I'll be posting all of the alerts for that coming up probably this week here in the Stocks and Psychology Money group, so stay tuned for that.